Okay, so moving on to vertical analysis. Vertical analysis shows the relationship of each item to a base amount or 100% figure. Other items were reported as a percentage of the base. When we're talking about vertical analysis, specifically for the income statement, we're going to be using sales revenue as the base. So every other line item on the income statement is going to be compared to sales revenue. Therefore, each income statement line item is divided by sales revenue. Sales revenue is the base for the income statement. When we do vertical analysis on the balance sheet, we're going to use total assets as the base. Total assets as the base. So every line item on the balance sheet is going to be compared to total assets. Therefore, each line item is divided by total assets. Okay, so let's take a look. Here's the vertical analysis of the income statement. Sales revenue is the base, and every one of these line items, every one of them is going to be divided by 858,000. So even sales revenue itself, so 858,000 divided by 858,000 is 1 or 100%. So just looking at just the first three line items, and then you can extrapolate from that all the way down. So sales revenue is 858,000, 858,000. That is the base. Sales revenue is the base. So we're going to take 858,000 and we're going to divide that by 858,000. That's obviously going to give you 1. In terms of a percentage, 1 is 100%. We'll look at cost of goods sold. We're going to take 513,000 and we're going to divide that by 858,000. The result is 0.6. 0.6 as a percentage is 60%. I guess if we're going to round this to the nearest tenth, it would actually be 59.8%. 59.8%. And then gross profit, we're going to take 345,000. We're going to divide that by 858,000, and that's going to result in 0.4. 0.4 as a percentage, rounded to the nearest tenth, is 40.2%. 40.2%. That is vertical analysis of the income statement. The base on the income statement is always sales revenue. Sales revenue will always be 100%. We can look at the balance sheet, and we're going to do the exact same thing, except the base on the balance sheet is not sales. Well, there's no sales on the balance sheet, so it can't be sales. The base on the balance sheet is going to be total assets. That's why total assets is 100%. So we'll just take a look at accounts receivable. It's at $114,000. Let's go ahead and put that here. Okay, so just isolating those two accounts, 787,000 divided by 787,000 is 1. As a percentage, it's 100%. Accounts receivable, 114,000 divided by 787,000, 0.14. As a percentage, 14.5%. Accounts receivable, 14.5%. Let's do notes payable. Notes payable equals $42,000. We're going to take 42,000. We're going to divide that by total assets. The base does not change. Even though it goes to liabilities, it does not change. Total assets is the base. We're going to get 0.05 as a percentage 5.3%. 5.3%. Now don't get confused when you look at total liabilities and equity. Well, the accounting equation stipulates that assets equal liabilities plus equity. Total liabilities and equity. So this 787,000 has to be the same as 787,000. So that means that 787,000 is 100% of 787,000. But just so that it's clear in your mind, this isn't the base. Even though it's incidentally the same number, the base is total assets, and all of the numbers you have on the balance sheet are going to be compared to total assets. Now from there we can prepare what's called a common size balance sheet. And really we actually already did that. The common size balance sheet is really taking these percentages and throwing out the numbers. Now you have to have the numbers here in order to come up with the percentages. But when you present a common size balance sheet, you're not going to put the numbers, you're just going to put the percentages. And what the common size balance sheet means that Supermart, you see this is relatively small, $787,000 in total assets. You know, try to compare this to, let's say, Save Mart. Save Mart's a grocery store, right? I think it is. Anyway, I mean, Save Mart is going to be in the billions of dollars. So when you're looking at 787,000 and all these numbers and you're trying to compare them to Save Mart, nearly impossible. But if you can convert all these numbers into percentages and then you convert Save Mart numbers to percentages, now the size of those numbers aren't really relevant anymore. It's just the proportionality. So what the common size balance sheet does is it gives us a benchmark. It can compare a company against either one, competitors, or two, the industry average. And the common size statement used to compare companies to each other reports only the percentages. So you do exactly what we did earlier, except you're just throwing the dollar amounts out and you're just going to use the percentages. Same percentages as the vertical analysis, which is what I just showed you. And the percentages allow comparison of companies of different sizes, which is exactly what I just told you. So Supermart compared to Target. And now since we're going to just focus in on percentages, we computed these percentages earlier. This is the actual income statement. You can do these with both the income statement and the balance sheet. The income statement, we're just throwing out the numbers that we had before to compute the percentages, and now we're just carrying over those percentages. And then we're going to get Target's numbers. How we do that, we may have to go to their income statement and compute these numbers, but when it's all said and done, we're just going to compare these two numbers in terms of a percentage. Now, in this case, even though Target's net income is going to be in the billions, you can use the common size income statement to see that Supermart, in terms of its relative size, is actually doing a little bit better, 5.6% versus 4.5%. So kudos to the management of Supermart because they're at least running it as well as Target. All right, we're going to move on to common financial ratios. So we already talked about horizontal. We've talked about vertical analysis. Now we're going to look at financial ratios. And we like to break up these financial ratios into specific categories. First, the first category is measuring the ability to pay its current liabilities, or what we often refer to as liquidity. How liquid is the company? Is it on the brink of bankruptcy, or is it set for liquidity and it's able to maintain itself for the foreseeable future? The next thing we like to look at is measuring ability to sell inventory and collect on receivables. This is the efficiency element about how we handle our inventory and our receivables. The next area we like to look at is measuring ability to pay long-term liabilities. The next area is measuring profitability. And then the last area would be analyzing stock investments. So we're going to go through and find out that there are a number of ratios that apply to each one of these areas. All right, measuring the ability to pay current liabilities. Again, this is often referred to as liquidity. There are three ratios that we're going to review in this course: working capital, current ratio, and the acid test ratio. Working capital is simply going to give you the difference between your current assets and current liabilities. So the formula is the working capital equals current assets minus current liabilities. Well, we can look at Supermart's 2017 working capital. Let's go ahead and see if we can just figure it out ourselves. Okay, we have the balance sheet, the vertical balance sheet. The total current assets, do we find it? Yep, we'll flow through here and we'll see, oh, there's total current assets, $262,000. We're going to compare that to current liabilities. Where do we find that? Total current liabilities, $142,000. We're going to take the difference between current assets and current liabilities. That becomes our working capital. $120,000. $120,000. The conclusion is that Supermart has ample current assets to meet its current obligations. If this were a negative number, then we would be concerned. But it appears it's not a negative number, and it appears to be large enough to maintain its current obligations, to fulfill its current obligations. Just so that we're clear, current assets, just a reminder, current assets as a definition, all assets that are either cash or will convert to cash or expire within 1 year. Current liabilities, all obligations that are due within 1 year. So naturally, it's for the basis of why we actually put the balance sheet in this format. You're comparing your current assets to current liabilities. This is what you have either in cash or will be cash soon, and you're going to be comparing it to what's going to be due within 1 year, so that it makes sense for us to be managing or analyzing those two together, because they're going to be very relevant, especially as it relates to liquidity, the company staying alive for the foreseeable future. The current ratio is pretty similar. You're going to be using the same numbers, except rather than subtracting the two, you're going to be dividing the two. You're going to be taking current assets divided by current liabilities. This is almost the same kind of an analysis, because you're really comparing the two, except we're throwing dollar amounts out and we're trying to see relative size relationship. So since we already have this is 2017 numbers, the current ratio, we're going to take current liabilities and we're going to divide that by current assets. We're going to get the current ratio, we're going to take current assets and we're going to divide that by current liabilities. So the ratio is going to give us 1.85. So for every dollar we owe in liabilities, we have $1.85. For every dollar we owe in current liabilities, that which is due within 1 year, we have $1.85 sitting in the bank account, or going to be sitting in the bank account, or will be converted to cash. We have $1.85 there. So that gives us a pretty good sense of us being okay. If this number we certainly want this number to be at least equal to or better than 1 at a minimum. If it's 1, that's getting a little bit scary because we're running real low. If it's less than 1, then we're having some issues here. But if it's larger than 1, and if we have a significant proportion amount that's above, that's what the textbook says. It says current ratios of 1.5 to 2.0 generally is considered to be strong. Well, we're right at 1.85, so we're pretty good. 17 was 1.85. If you go and run the numbers for 16, it was 1.87. Asset test ratio is the same ratio, close to the same ratio, except we're going to throw out some things as far as current assets are concerned. So what are we going to focus on? That what we know will be cash or converted to cash. So specifically cash, short-term investments, and net current receivables. Those three items are going to be divided by current liabilities. Go to the balance sheet. So cash, accounts receivable. That's it. We don't have any short-term investments. So it's simply going to be cash and accounts receivable. We're going to throw out inventory and other current assets. We're going to say, look, we're not sure about those. We're not so sure about these, so we're just going to focus in on cash and accounts receivable. So 29,000. Say we have cash. It's 29,000. We have accounts receivable, 114,000. We're going to add these two together. We have 143,000. So cash and AR. Again, if we had short-term investments, we would include that in here, but we don't. So, and we're going to compare that to current liabilities. We have that number already. That was given. That's 142,000. So now we're going to take this 143 and divide it by 142. To the nearest 100, it's 1.01. Let's see what they came up with. Yep, 1.01. What the textbook suggests is anything between 0.9 and 1 is acceptable in most industries. Well, we're at 1.01, so we're pretty good to go. The next section talks about measuring the ability to sell inventory and collect receivables. So the three ratios we're going to look at are inventory turnover, accounts receivable turnover, and days sales and receivables. Inventory turnover. I guess what you can think about inventory turnover is if you can imagine that the room you're sitting in right now, whatever room you're sitting in, just fill it up to the brim, to the very top of inventory. They're boxes or stuff, whatever you're selling. This is what you sell and you've got it in inventory. This is what you maintain on average as inventory. The question becomes, how many times do you sell that room full of inventory? How many times do you sell that room full of inventory in 1 year? How many times in 1 year? Okay, the same concept is what we're looking at for inventory turnover, except rather than looking at a room full of inventory, we'll look at dollar amounts. How many times does our inventory dollar amount get sold in 1 year? Okay, so to do this computation, we're going to take our cost of goods sold. The inventory turnover rate is computed by taking the cost of goods sold and dividing it by the average inventory. The cost of goods sold, which is going to come from the income statement, and we're going to divide that by the average inventory. So the cost of goods sold is in the inventory. Let's go to the income statement. Cost of goods sold, 500 for 2017. It's $513,000. Let's go plot that down. So cost of goods sold based upon what we just saw, $513,000. Now, the next thing we're going to do is come up with the average inventory. So how do we do that? We come up with our beginning inventory. Now we're talking about 2017. So our beginning inventory, let's go to our balance sheet. There it is. Our balance sheet inventory, well, at 17, we're saying, okay, well, that's $113,000. We're going to have to go back even before that. Yeah, we'll go to the comparative balance sheet. Inventory is $113,000, but that's not our average. So what we're going to do is figure out, well, what was the beginning inventory? The beginning inventory, well, that was equal to the ending inventory from the prior year. The ending inventory for the prior year was $111,000. So since 2016 ended with $111,000, that's going to be our beginning inventory for 2017. Our ending inventory, this one we do have, that was $113,000. Let's confirm, $113,000. Okay, so we just took the inventory, we took 111 and 113, 16 and 17. And now we can compute the average inventory. So we take the beginning. We'll take the beginning, we're going to add to that the ending. We'll do that first. That's why I'm putting the formula here, and you can see they're in brackets. So we're going to make sure we're going to do that first. We're going to add these two together first. Whatever the result is, we're then going to divide that by 2. So our average, you might have been able to eyeball this, right? The average is 112. So inventory turnover, we're going to take 513,000, and we're going to divide that by the average, which means 4.58. Let's see what they came up with. 4.6. To the nearest tenth, 4.6. Okay, there's the formula. This is exactly what we just did. We took 513,000, we divided by 111,000 plus 113,000 divided by 2. So the average inventory is here. This is the average. We take that average, we divide it into 513,000, that gives us 4.6. Looking here at the formula, you have Supermart's 2017 inventory turnover. They take their cost of goods sold of 513,000 divided by the average inventory, which is exactly what we did. We took 111,000 plus 113,000. We added those together and we divided it by 2. That gave us the 112. And so 513,000 divided by 112 give us 4.6. Accounts receivable turnover is going to be pretty similar except using different numbers. But what we're going to do is take our net credit sales and we're going to divide that by the average net accounts receivable. Net credit sales, focus on credit, net credit sales. Now, unless you're given otherwise, you can assume that the amount of sales you have in one year is all credit sales. Otherwise, you'll have to be given that there's something more to it than just that you may have some cash sales and some credit sales. But just assume, unless you're told otherwise, that whatever's showing on an income statement is all credit sales. And divide that by the average net accounts receivable. And what this does is helping us measure ability to collect our cash from accounts receivable, from credit customers. All right, so we're going to need the income statement for sales for 2017. Sales, Supermart, comparative income statement, sales 858,000. So let's go ahead and plot that down. And then we're going to have to come up with our average AR balance. So to come up with our average AR balance, we have to come up with beginning AR. Beginning AR, we're going to look for the accounts receivable is always on the balance sheet. So we'll go to the horizontal, the comparative balance sheet, and we look for accounts receivable. And because we're coming up with the average, we're going to do the same thing we just did with inventory. We'll get the beginning, which is 85,000. Our ending AR is 114,000. So that our average AR So follow the formula closely. What we're going to do is we're going to put these in parentheses. We're going to take the beginning plus the ending. We're going to close that parentheses. We're going to go ahead and do that first, and then we're going to divide that by 2. So the average AR is $99,500. And now to compute the AR turnover, the formula is taking your sales and dividing it by your average AR. I think they round it to the nearest tenth, so it's 8.6. Let's see what they got. There it is. Accounts receivable turnover, 858,000, divided by the average, which we learned how to do that, comes up with 8.6%. Now, the 8.6, just as a measure of receivables, the higher the ratio, or the higher the number, the higher the number indicates faster collections, cash collections. So that's what we're really looking for when we're trying to analyze. We want to make sure that the company is actually collecting its receivables within a pretty short period of time. Same with inventory. We do want a high number here because the higher number indicates that we're selling it quicker, that we're moving the inventory faster, okay? So high inventory and high accounts receivable turnovers are good things. Now for accounts receivable, we can actually convert the inventory turnover to days in sales. And to do that, we're simply going to take the net sales and divide that by 365 days. Now that we have 1 day sales, then we can take that number and use it to compute the days sales in accounts receivable. And the way we do this is we take our average net accounts receivable and we divide that by 1 days of sale. What that does is it measures how many days of dollars are sitting in the accounts receivable. We'll get our 1 day sales by taking our net sales and divided by 365 days. So we can go ahead and just look at this. 858,000 divided by 365 days gives us $2,351. That's how many sales we have per day on average. And then we'll take our average inventory, which we've already computed this. We'll take 85,000 plus 114,000. We'll take that, add it together, divided by 2. So this gives us the average amount of accounts receivable. And then we're going to divide the average accounts receivable, this number here, we've already done this. What did we come up with before? 99,500. 99,500 is here, divided by the 2,351 gives us 42 days. So on average, it's our accounts receivable collection in days is 42. And then we have to then look at that number and compare it to others in the same industry standards, or even one other company to see if we're doing better than that one or not doing as well as that one.